This is an interesting market. Do you think we're in for rough times? Curious to hear what your thoughts are. Always feel free to chime in the chat below. But today we got a good show for you and a special guest.
Ever dreamed of living in the heart of the Colorado mountains? Join me, Matt Dayton, Breckenridge native, Olympian, and mountain real estate expert. Here on the Ski Summit Show, we dive into everything you need to know about buying, investing, and living in iconic ski towns like Breckenridge, Frisco, and Keystone. From mountain real estate trends to investment opportunities, we bring you on the inside to help you make the most of your mountain life.
So welcome to the Ski Summit Show, episode number 114, where we talk about everything in the mountains for real estate. Got my producer, Benji, what Benji does here. Thanks, Benji, for heading things up.
No problem. I don't know.
And we got my buddy, Chris Magnotta with Elevate Home Loans today to kind of give us the scoop. So, Chris, thanks so much for being here today.
Awesome to be here. Great to see you. Keep the stoke high.
Yes, absolutely, man. You're looking good, looking healthy. Imagine you're getting some bike riding in these days. You're always on your bike.
Always on the bike. Always on the bike. Yeah, keeps me
Living
sane.
You're always available too, though. So do you just have like a laptop and a phone, like you?
I probably do a little bit more, from the phone than I'd like to admit. Even so, when I'm climbing, I can pedal and text, and obviously voice to text really helps. However, you get the wild cards out there. So you're like, oh crap, that's not what I meant to say. And autocorrect, so you got to deal with some of that. But at the end of the day, you can still get a lot done on the climbs.
Well, we won't tell the state patrol out there that you're pedaling and, texting at the same time.
Is that breaking law? It probably is.
I'm sure they'll probably come out with that. So.
Yeah.
But, well, cool. Well, thanks for being here. I'm always leaning on you as a wealth of knowledge, and I really appreciate the intel that you're able to give our customers and clients. But yeah, what are we curious? What are you seeing in rates right now? We're kind of not really trending the way we've hoped, is what I'm feeling.
Yeah, it's definitely been a rough kind of week and a half. We've seen some dips, some spikes, but they've been kind of in a fairly narrow range, I would say, for the last couple months. Kind of, in that high 6 range. They did blip up over 7% there for a little bit last week. Technically right now they're squeaking in just below 7% this morning, but yeah, it's been a lot going on for sure in the market, and a lot of weird things are driving interest rates that maybe don't always drive interest rates. Typically
what is that?
Typically it's always your inflation and your employment that are the two big drivers, and inflation's taking a little bit of a backseat at the moment because right now, with all the stuff with the Trump tariffs and all that stuff.
I just paid $20 for a sandwich. So
you paid $20 for a sandwich, and it was probably with half the meat that you had in your previous sandwich, I would assume.
It was. The milk smaller, my everything.
No discounts anymore. Do you get any local discounts anymore on anything?
More like a bagel.
Right. So now, I still think the job market's a big driver, right? At the end of the day, softening in the job market will bring interest rates down. And we saw that for a little bit. When the Trump tariffs first came out, actually, it's this is inflation, this is recessionary, and, people are going to lose their jobs. And so initially when that started, it kind of was good. But then they're and the market changed their mind. All of a sudden now the Trump tariffs are bad. And, that had to do with a lot of just realizing hey, maybe the U.S. is less desirable place to invest money. And so that took money out of our markets. And so, we're seeing a lot of weird things right now. And one of the biggest, I would say, thing that's driving the market is just a lack of buyers for our debt. That's a big thing. The America at the end of the day, our debt. Yeah. So specifically treasuries and mortgage-backed securities, at the end of the day, interest rates are kind of driven by the Fed, but Fed policy is a big part of it. But mortgage rates specifically, it's all about those 10-year treasuries. And we got to sell those 10-year treasuries on the open market. That's how it works. So people come and buy those. Maybe you bought some, maybe your retirement portfolio bought some, but a lot of them are sold internationally. And so a lot of international buyers like China and Japan and Europe, a lot of places buy our bonds. Well, if U.S. is seen to have a little bit of a debt problem, our bonds have become a little bit less attractive.
It's just a little problem.
Just a little bit less attractive. And if our debt is less attractive, the only way to get people to buy it is to get the interest rates up a little bit, right? So we're kind of seeing a little bit of stuff going on an international level, less demand for our debt because we're just issuing too much of it. and it's not being absorbed by the market. So that's a big part of it.
Okay. No,
Yeah.
that makes a lot of sense. And so do you see any changes that the new housing director could make to impact rates?
Actually, yeah, that's for sure a big one. Every 4 years, an incoming administration often flips the housing director, which is what happened this time. So Trump came in and ousted the previous housing director, and the previous housing director did a lot of things that were very left-wing, and the new housing director looks like they're going to do a very bunch of things that are very right-wing. And
yeah, that works.
Shocker, right? I'm really unbelievable.
Did not see that coming.
Did not see that coming. But one of the things that is going on right now and keeping interest rates high is lenders have to pay Fannie Mae and Freddie Mac a ton of money to do a loan. So specifically, second homes and investment properties and what we call high balance loans, like conventional loans that are like, over like $1 million, 1.4 million. Those conventional loans, like we as a lender pay a boatload of money. So let's say you're getting $1 million loan, Matt, and I'm helping you, and I'm going to take your loan and I'm going to sell it to Fannie Mae or Freddie Mac. Okay. Well, as a lender, I have to pay about 1.6% to get that loan done. So that means I have to do one of two things. I either have to increase your fees or I have to increase your interest rates because I got to cover 1.6%. So these are called LLPAs and guarantee fees, and they're different amounts for different loan types and loan amounts, and that gets really, really weird and complicated. But the reality is right now, Fannie Mae, Freddie Mac, and Ginnie Mae, which are kind of government controlled, right? They are getting $30 billion a year right now in profits that goes to the Treasury. So the idea is there's a lot of meat on the bone. There's a lot of cheddar there in that $30 billion. And if us lenders aren't paying these crazy fees to get loans done, we could actually lower interest rates. And specifically there's certain loans that will be benefiting more than others. Larger loans, like, the $1 million loans, the second homes and the investment properties are probably the most likely to benefit from changes. But nothing's been announced yet. But those, like if you went back to what it was 4 years ago, I don't know if you remember this, Matt, but you could do 10% down on a second home and have like the same basic interest rate as a primary home. Well, now 10% down second home is basically non-existent, right? Like you don't see that anymore. But 4 years ago you did, and you got really smoking rates for doing it. So that's a great example of something that where the previous administration housing director, made the fees really high for that type of loan. And so the new housing director could come in and say, hey, we got to trim a lot of fat here. And we have all these fees that are being paid out right now and $30 billion. So it's a lot of meat on the bone.
Now, I mean, are they really going to take a hit with that $30 billion and say, oh, yeah, no GQ public, you don't have to pay that anymore?
Yeah, so that's a big question. And that's where it gets really, really complicated because at the end of the day, like, Trump has been very vocal about making Fannie and Freddie private and not being a GSE, government sponsored enterprise. And so it is going to be more, and there's definitely different philosophies on why that's happening. Generally right-wing people are more in favor of smaller government. And so that's why a lot of people say it's being done. We're trying to reduce the size of government control and that kind of thing. But then there's a lot of other people who'd be like, well, yeah, because there's also a lot of, hedge funds and things that would benefit dramatically from a privatization of Fannie and Freddie. So, when it goes into like, $30 billion coming into the Treasury is a really nice line item on the budget. But at the end of the day, they're also cutting taxes at the same time, which is also a really good line item on the budget. So I think what they're trying to do in general is they are definitely trying to get interest rates down. This administration has been very vocal about trying to bring interest rates down. I think it's really important for them for their midterm elections to get mortgage rates down. I think it's really important to have lower interest rates to help fight the trade war. At the end of the day, trade war is bad for the economy. We see that with the stock market. No shocker there. Lower interest rates are good for the economy. So it allows Trump to be more aggressive and more nimble in other areas if interest rates are lower. So I think kind of in a nutshell, we're talking about some $30 billion, but I think it's at the end of the day, it's a bigger play on what the Trump administration is trying to do.
Do you feel like that there's a rate point percentage-wise for the housing market where there's just a good threshold that we meet? If we go lower than that, we're going to get into unhealthy inflation and home prices. I mean, where is a good healthy number?
Yeah, I think it's changed. I think people have become to accept the higher interest rate environment more. I would have said, 2 years ago, I probably would have said, 5. But now I think even 6 would really actually stimulate a lot of demand. And we saw that in little blips. Like, if you look back to September of last year, we actually got really close to 6%, a very short period of time, but we did. And I tell you, loan application data, purchase, specifically purchase, demand, people wanting to come out and buy a house, like it heated up really fast. So I think that, if we can get to a spot where, we can stay at like around 6% for even just, a few months, I actually really think that brings out quite a bit of demand, and would stimulate the housing market, kind of get it into more of a healthy position, but not get into like the craziness of COVID with our 2 and 3% rates that were obviously way too low. And in hindsight, right, obviously way too low because they just pushed prices up too much.
Too low, too long. Yeah. No, that's encouraging to hear, because we're definitely seeing our inventory build quite a bit right now, which is a good thing. We need more inventory. You wouldn't want to see those rates just plummet down really low where we just get that all gobbled up again and create an unhealthy supply demand ratio. So, but yeah, as we see that inventory raise, it's going to be a really interesting summer. I think we're going to see some houses sit on the market for quite a while, and some sellers that are going to have their come to Jesus moment, or just resolve that they're not going to sell.
Right. Yeah. No, I think that, and that's pretty similar in a lot of markets. So whether it be here in Steamboat, I do a lot of stuff in Denver and Grand Junction and all over the place. Right. And the story is pretty similar across all the markets. Like, we're seeing inventory grow faster than we're seeing demand for housing grow, for housing. And so, inventory can be up, 30, 40, 50% plus in some areas. And so, I think we are going to see some of that softening, unless, of course, that's the big thing, interest rates do go down. But that is part of what the Treasury Secretary is talking about. So I don't know if you've been clued in on Mr. Scott Bessent. So he's our new.
We got a new Treasury Secretary. Is that so taking things up?
Yeah, it could. It really could, because remember, Trump tries to fire Jerome Powell, right? Like, we got rates lower. We got to fire Powell. Supreme Court says, "Oh, sorry, no can do." So
you're fired.
You're fired. No, can't do it. But one of the other plans that the Treasury Secretary has to get interest rates lower, which really could work, and they're saying by summer, is some of the deregulation. So how that would work, right? So there's a few things that work. One, just know as a lender, a lot of costs are in regulation. I probably pay about $1,500 per file in legal and compliance. Now, most of the time, you don't see a line item, like you don't see a legal charge to the buyer. No. Like, you don't see that. You don't see that on the settlement statements. But we're paying it behind the scenes, kind of like we're paying these expensive Fannie Mae, Freddie Mac fees behind the scenes. And so lenders have higher rates than they would be because of all these costs, right? And so if we could shed some of these legal and compliance costs, just like we could shed, some of these Fannie Freddie fees, that definitely could bring interest rates down. And even more so than that, part of the deregulation is actually to allow banks more leverage, more ability to borrow, specifically 10-year treasuries, which is what drives mortgage rates. So getting off on a little bit of a tangent here, but I promise there's a good point. So if the banks, who are now limited on how much treasuries they can buy, that is unlocked, and they can go and buy treasuries, that can really change the dynamic of the market. Because remember, back to my earlier point, we're running out of people to buy our debt.
Yeah.
And we have a buyer sitting there waiting in our banking institutions, and they would love to buy a bunch of these treasuries, but they can't because there's a bunch of regulation around that. So by loosening that up, you could actually have banks buying a bunch of treasuries, which would actually bring down mortgage rates. So it could be really weird and backwards. Okay, so check this out. Like, these regulations were put in in 2008, or following 2008, I should say.
Okay.
And because, of course, the government had to bail out the banks, right?
Yeah.
Well, now the government is the one who's kind of bankrupt, not the banks. And so
Okay.
the banks could almost be a little bit of bailing out the government here, because they have an absurd amount of money, and so they can actually go in and make a dent in what's going on with our issuing of treasuries and things like that. So that's one of the things Scott Bessent's been talking about, and actually even the Fed mentioned it. I guess it was probably like 4 months ago. The Fed did make a little comment about it. No one kind of really paid too much attention to it, but it could be kind of like a miniature quantitative easing, like we saw in COVID, where remember, rates were super low in COVID because the government was buying mortgage-backed securities, buying treasuries, right? That's what brings rates down. Well, now it could be the banks that are doing that instead of the government. And so that could bring rates down. So that's one way that this administration's looking at interest rates in a way to try and get rates down as soon as what they call, quote, summer. So I don't know if summer is now. I don't know if summer is in July or August. I don't know what they mean.
Well,
by summer,
we're still waiting for spring here.
Yeah, we're still waiting for spring. I know, right?
Summer's like August. So that's just my view of it. So.
Well, August is when it is. So, but yeah. Anyway, that going back to what you were saying before. Yeah, we definitely have some growing inventory. And, we've seen the price growth slow down, right? Some areas we see, I have a guy today, it's like bidding more. And then over here, you got just a house sitting doing nothing, right? And prices going down. So it's still, very much a mixed bag based upon the property and market and the neighborhood and all that fun stuff. But yeah.
Your 2 days or 200 days, which.
Right. I know. It's kind of that, polar opposites. It's wild times for sure.
Yeah. No, I think, if you got a desirable property that's a scarcity, there's a demand for that. So
yeah.
Or some great deals that are just like too good a deal to pass up. Those are going quick too. So
yeah, I've definitely seen people scoop up some properties. I was like, wow, I feel like I did a place for $100,000 less or $100,000 more than that, like a year ago or 2 years ago.
You can't just sell anything, that's for sure. So no more just if you have a pulse or fog a mirror, you can sell real estate. It's not the case these days. So but. Well, cool. Well, awesome. Well, thanks for unpacking that for us. There's a lot of good information there. So always appreciate the knowledge and the insight. So if anybody needs a good lender that knows what they're talking about, Chris Magnotta, Elevate Home Loans. So awesome. Thanks Chris, Matt, for being here.
Yeah, have a good one.
Well, that moves us into the listing of the week. Today, we've got 2 listings in Breckenridge, and they're both A-frames. How cute is this? I'm so excited for A-frame houses.
I love A-frames, man. They're like, they're one step above the dome house as far as
no, there's so many steps above the dome house.
Use of space. My grandparents had a dome house, and it was like fitting things into a round. Nothing's round.
No, nothing.
I just picture Austin Powers on like the circle bed. On the dome house. So I don't know what kind of bed you put in an A-frame.
I don't know. Probably hopefully a square if you've got it against. There's no wall, is there?
Big cheese slice of a bed. I don't know. But
the first house is 181 Shekel Lane in Breckenridge.
Yep, Silver Shekel neighborhood, one of my favorite neighborhoods in Summit County, right between Breckenridge and Frisco. Just easy to get to. A lot of great folks in this neighborhood. I'm a fan. You got some good homes, some good views, and it's on the north side of Breckenridge. So leaving Breckenridge, you don't have to go through any of the skier traffic to get out of town and get on I-70. But it's easy to get to town. So there's your A-frame.
It says it's it, but I can't see it good from the road.
Let's see what they did with this.
It looks cool. Look at that.
Yeah, that looks kind of fun. I
like a little bit, so it looks better.
I like the way these just bring you in. I saw an Airbnb A-frame. They just created this whole glass ceiling. Recently.
Oh man, look at this first floor. It's so good. This is not what a typical A-frame looks like.
It doesn't. Like the way they kind of accented the wood with the white. That looks really good. You got some natural elements with some stone. Brought in a little bit of color. They actually did a really good job of staging this.
Is this an awning or a heater?
I think it's an awning.
Yeah, it's an awning, yeah.
Yeah, looks like an awning.
What a cool house.
Yeah, it's just like a little bit sweet.
I love it.
It's a cool like floating type thing on the bed. Yeah.
And then there's like this thing closes. Like it's a whole trap door so you can go downstairs.
Oh yeah, look at that.
So
Shut
you
the
get
door.
all of the square footages on the second floor. Look at that.
Got to maximize it. These built-ins, they maximize that. They did a fun job with this one.
I
Looks
really
cool.
like this A-frame.
Yeah.
I've never seen one like this.
No, they pulled it together really, really well.
Even the kitchen is cool.
Yeah. No, it's like a good little mix of modern. Definitely, they did a beautiful job with this.
Yeah.
I could live in that A-frame.
Oh man, all day. The rest of my life probably. It's got
maybe
a gym in it.
I'm probably not tall enough to have a real problem with A-frames. I could see if you were really tall.
Yeah. The shower here is the only thing that I think I couldn't use.
Yeah, no, you're pretty tall, right? I mean,
My shoulders wouldn't get through there.
yeah, like a life on a boat.
I'd be taking a really tight shower.
So yeah, it looks like kind of next thing they could do some updating with the siding, but the inside is really cute. So it looks like some nice views too.
Yeah.
Great deck space. Yes, we'll take it.
I'll take it. That's really cool. I want to see this other one now. Let's go see.
Yeah, let's see what the other one looks like.
Number 2. This is for $1,599,000. This is 6365 Highway 9, Breckenridge, Colorado. Another A-frame. Oh, let's look at the map.
Yep. So Blue River, south of town. If you like winter, you'll like Blue River. You got great places to go skiing up there. There's great trail access, backcountry ski access, and it's just quiet up in Blue River. You got a lot of space, wooded, privacy from neighbors. So yeah, that's right off kind of the main road that goes through Blue River.
It's very private.
Yeah.
So private, I can barely see that.
Can't even see it. And that's not even with the
there.
aspen. There you go. And that's not even with the aspen leaves filled out. So that'll be totally tucked in there.
That's so cool. I already love this.
That looks cozy, doesn't it?
It does.
Yeah.
It's got a carport. Oh man, look how
Cool. I like the gray wood with the white. Looks like they did like kind of, can't tell if that's a steel fireplace. It kind of has a little bit of a mid-century modern flair to it, at least with the furnishing. That green chair upstairs kind of gave off that feel.
I love the way they did the stairs in this. It's just tucked away. It's not like some big staircase in the middle of everything.
No. It's all really open. Makes you want to go out and buy an A-frame and flip it.
Or just live in it and become a recluse.
Yeah. Just cozy
Oh
up.
man, what is this kitchen? This isn't an A-frames.
No. it
That
doesn't
is
seem-
insane.
How does that fit in there?
It's got like
It's like
mini.
the Doctor Who elevator. For those of you that don't know what I'm talking about, you're probably not watching this show.
Yeah, this is a really great use of space too. Bedroom.
No, I love it when you can just tell when people take really good pride in their homes and they just put a lot of thought into it. This is one of those.
Good
Beautiful.
bathroom.
Yeah. When you go through like remodeling your own house and doing stuff to your own house, you realize how much work and energy and money and brain power all these things take.
Yeah.
So anyway, well, cool. Those were fun.
Yeah, buddy.
So, well, thank you for joining us for the Ski Summit Real Estate Show. Enjoyed having you here. Please consider subscribing if you enjoyed the show, if it was helpful. Either way, we really appreciate you being here. Until next time, hope to see you in the mountains soon.
Get moving.